Hello friends and subscribers, a very warm welcome back to another episode of Readings in Impact Investing. My name's Daniel Rosehill. This is a new podcast intended to take written material in the field of impact investing and make it more accessible through reproducing it in audio format. This podcast is available at readingsiниmpact.org. That website will redirect to a link tree, and on that link tree you can see basically all the places that you can subscribe to the podcast, including Google Podcasts, Apple Podcasts, Spreaker, Spotify, could go on with the list, but a lot of different places. My email address is also listed there. It's public@danielrosehill.com. So do feel free to suggest material if you have come across some useful report or document. I have my own method for finding these, but I'm always glad to receive tips from people as well. So today I'm going to be reading, I was trying to look for documents about blended finance because we've talked about catalytic capital, and blended finance certainly comes up a lot in those materials. So I came across this document from USAID. It's called the Invest in Blended Finance Starter Kit. It's a nice little document. It is, 16 pages, and it's called 10 Questions About Mobilizing Private Capital for Better Development Results. And this was put out there in March of 2020. So just to bear in mind the date, it's a little less than 3 years old. Firstly, just a quick word on USAID. I'm reading from their mission statement. On behalf of the American people, we promote and demonstrate democratic values abroad and advance a free, peaceful and prosperous world. In support of Americans' foreign policy, the U.S. Agency for International Development leads the U.S. government's international development and disaster assistance through partnerships and investments that save lives, reduce poverty, strengthen democratic governance, and help people emerge from humanitarian crises and progress beyond assistance. So that is what USAID does. It's the U.S. International Development Agency, basically. So let me just get back now to their document, and I'm just going to start reading. Blended Finance Starter Kit, 10 Questions About Mobilizing Private Capital for Better Development Results. What is blended finance? Blended finance is the strategic use of development funds, such as those from government and philanthropic sources, to mobilize private capital for social and environmental results, such as improving infrastructure, education, agriculture, healthcare, and more. Blended finance strategies are designed to encourage members of the private sector, such as companies and investors, to invest in activities and projects that can achieve both financial results and positive social and environmental outcomes. How can blended finance encourage investment into developing countries? Investors constantly weigh the potential return of investment, the money it makes over time, against its risk, the possibility of the investment incurring a financial loss instead of a return. Blended finance enhances an investment's potential return or mitigates its risk factors, making it more attractive to investors. In other words, blended finance interventions improve the investment's risk-adjusted return. Risk-adjusted returns influence an investor's decision to invest in an activity, fund, company, etc. If two investment opportunities have the same anticipated return over the same duration of time, the one that has the lower risk will have the better risk-adjusted return, making it more likely choice for investment. All investments incur some level of risk. However, investments in developing countries and frontier markets often present risks such as macroeconomic, political, regulatory, currency, and information asymmetries that are volatile and more difficult to mitigate than those in developed markets. While developing countries often have attractive investment features that developed economies lacked, such as high yields, fast-growing economies, and uncorrelated markets, if the risk-adjusted returns aren't as attractive as the investment options in other markets, commercial investors simply won't engage in these opportunities. Through blended finance interventions, international development agencies can use their financial resources and development expertise to drive commercial investment into markets, sectors, projects, or companies that the private sector would not otherwise consider. Blended finance aims to make development spending more catalytic, meaning that for every public or philanthropic dollar spent on a development project, additional dollars in private capital are mobilized to invest alongside it, ultimately increasing social and environmental impact. How does blended finance work? In blended finance transactions, development agencies alongside other public or philanthropic actors use special strategies to improve the risk-adjusted return profile of a deal, thereby making it more appealing to investors. Blended finance transactions are often complex, yet development agencies often rely on a few fundamental interventions to support such transactions. One intervention involves participating in the structuring of a deal. Structuring is the combining of different types of capital, risk mitigation, and incentives to attract investors and appropriately fund an investment. Capital structure in blended finance refers to the specific combination of debt, equity, or grant capital used to finance an investment. Debt and equity are the two main ways to raise money for an investment. By taking on debt, the borrower owes another party money, pays interest to borrow that money, and has a defined repayment schedule. By taking on equity investments, the investee is allowing an outside party to take partial ownership of the company. Lenders who issue debt are paid back before equity investors gain profits, so lenders take on less risk than equity investors. For this reason, equity investors expect a higher rate of return and more control over the investment. However, unlike debt, equity investments do not have to be paid back, which can be helpful if a firm encounters a period of declining earnings. Capital structure also includes the priority of investors and lenders in terms of absorbing losses and earning a return. For instance, although lenders receive payments before equity investors, even within the group of lenders, certain creditors will be paid back before others. Having the right percentage of each type of capital in the structure is vital to the success of a deal. Repayments need to match on the investment's projected cash flow, and the cost of obtaining the funding needs to be less than the investment's overall profits. International development agencies can attract private investors to participate in a deal by injecting catalytic, aka concessional capital, into its structure. Concessional capital is a type of financing that has more favourable terms than those which are set by the market. For example, it may have low or no interest, grace periods for repayment, or long payback timelines. Development agencies can provide catalytic capital in the form of grant-like capital for which there is no expected payback. By contributing a new layer of capital into the structure, development agencies can absorb lower returns on the first financial losses, thereby protecting the returns of private sector partners if the investment does not turn out as forecasted. Ultimately, the presence of catalytic capital helps to de-risk investments and create the appropriate risk-return ratio required to crowd in private sector investors. I just want to pause here to interject a couple of notes of my own. In this sentence here, let me just reread it. Ultimately, the presence of catalytic capital helps to de-risk investments and creates the appropriate risk-return ratio required to crowd in private sector investors. We have two terminologies here that are used an awful lot in the world of impact investing: de-risking and crowding in. I'm not sure I could offer a definition off the top of my head, but I think this sentence explains both terms perfectly understandably. So when we're talking about de-risking in the context of development finance, we're often talking about exactly this: catalytic capital and blended finance, that these DFIs or aid agencies are coming in and absorbing more risk, thereby de-risking the subsequent, this is how the mechanism is supposed to work, that when the private market investors come in looking for market rate returns, the market has been de-risked. And there are various de-risking mechanisms. Perhaps I'll do a separate episode about those, like first loss tranches in a structured finance deal. The second one is crowding in. It's kind of a funny term, right? Crowding in. You kind of, I don't know. I always, when I hear crowding in, I visualize sort of a crowd to get into a door or something. But it is kind of that sort of same image in the world of finance, by which these guys are coming in first, and then when we're talking about crowding in, we're kind of saying that, okay, so the development finance institution, the catalytic capital provider, is going to be the first person coming into this deal, and then the objective is that it's going to bring in other investors, and that's just referred to colloquially as crowding in capital, or crowding private capital. It's just kind of a turn of speech that seems to have really caught on, or those are my observations. So they have a nice little flowchart here, illustrative blended finance structure, priority of return, first loss investors, example investors on the left. And I'm conscious of the fact that people can't see this. So I'm just going to try to explain this graphic as best I can verbally. Example investors and illustrative terms. So the first loss investors are the first set of example investors, and their illustrative terms might be no returns. Then equity investors, uncapped returns, and finally lenders, returns capped. Blended finance interventions do not always require international development agencies to participate in the structuring of a deal. Very important. I think I've seen it remarked that a lot of people think that blended finance requires DFIs. Well, that's not actually always the case. Instead, development agencies can use their resources to improve an investment's risk-adjusted returns via other approaches, including the financing of technical assistance such as transaction advisory services and sidecar facilities. The lack of transaction advisors in emerging markets often creates barriers that prevent private capital from entering these markets. By covering the fees of transaction advisors, development agencies can incentivize investors to work on deals in emerging markets that they would otherwise avoid because these markets tend to be riskier and less profitable than developed markets. A technical assistance sidecar is a facility through which fund managers can provide portfolio companies with business advisory services, thereby decreasing the risk associated with investing in these companies. So let me just repeat that. Again, slightly unusual terminology. A technical assistance sidecar. Often I've seen it more commonly referred to as Entrepreneurial Support Assistance, ESA, or sort of acronyms like that, basically referring to the same idea. That it's not necessarily just about the catalytic capital. In fact, there was a very good article that I did an episode about recently from Kusi. His surname evades me. He's got a great book called Scaling Impact, which I'm currently reading. And he talks about this misconception that catalytic capital can only take the form of financial injections by grant capital, in other words, by DFIs, etc. And in reality, there's other things it can do. It can be experiments on a market, or it can be providing entrepreneurial support, which is again a form of de-risking, because if you're going in to support the entrepreneurs in an emerging market and making them more competent, they are less riskier investees. So that can be a form as well. So let's continue here. Other blended finance approaches that development agencies use include providing a guarantee to lenders in the case of losses, purchasing insurance against certain risks, or assisting in the development of a project so that its fruition appeals to private sector actors and simultaneously has social and environmental benefits. Deploying blended finance to achieve commercially acceptable risk-return profile. This is another graphic here where they have the expected returns are coming into line with market rates, but starting out as too risky, and blended finance coming in there. Chapter 4, or point 4 of this excellent PDF. Who are the key players in blended finance transactions? Structuring blended finance transactions successfully may require the participation of many parties, including but not limited to international development agencies and philanthropic organizations, private investors, DFIs, development finance institutions, multilateral development banks, MDBs, and intermediaries. Firstly, let's look at international development agencies. International development agencies are funded by governments. They support the economic, environmental, social, and political development of developing countries. In blended finance transactions, depending on the development agency's structure and authorities, they can provide catalytic capital, guarantees, and technical assistance, all of which help to crowd in, again that word crowd in, private investors. They also bring valuable development expertise, knowledge of local context, and in-country networks. However, because international development agencies have traditionally deployed funding through grants, they generally lack the investment expertise necessary to structure financial transactions. Examples of international development agencies include the United States Agency for International Development, USAID, who is the authoring party of this particular document, the Danish International Development Agency, and the European Commission's Directorate General for International Cooperation and Development. Philanthropic organizations are non-profit, non-governmental organizations that use donations and income to fund and provide social services. Some philanthropic organizations like the Bill and Melinda Gates Foundation, the Shell Foundation, and the Rockefeller Foundation use blended finance strategies in their programs. Private investors have significant pools of capital under management. These investors include institutional investors, family offices, and high net worth individuals. Institutional investors are organizations that make large investments on behalf of their members or clients. Each of the 6 segments of institutional investors, I'm going to read these out. The 6 segments are insurance companies, sovereign wealth funds, commercial banks, investment banks, private equity firms, and asset or wealth managers have different mandates, constraints, and risk-adjusted return preferences that affect their ability and desire to partake in blended finance transactions. MDBs, multilateral development banks, are international financial institutions set up by 2 or more countries to provide financial assistance, traditionally in the form of loan and grants to other governments, to increase economic and social progress in developing countries. Examples of MDBs include the World Bank, the Inter-American Development Bank, that's IADB, and the Asian Development Bank. DFIs are usually majority owned by one or multiple national governments. They support private sector growth in developing countries by providing capital for activities that would not be able to secure funding from commercial lenders. Examples of DFIs include the US International Development Finance Corporation, the UK CDC Group, Investment Fund for Developing Countries, the European Investment Bank, and the German Investment Corporation. MDBs and DFIs have significant investment expertise and wide networks across developing countries. DFIs and the private sector arm of MDBs have development mandates, yet they lend exclusively to the private sector. As such, they sit at the intersection of concessional, catalytic, and commercially oriented capital, making them well qualified to structure deals that achieve both financial returns and development results. Given this expertise, they often act as the intermediary in blended finance transactions. Intermediaries facilitate transactions between those in need of capital, for example, projects, funds, and companies, and those with capital, investors, and lenders, for the benefit of both parties. There are 2 types of intermediaries: financial intermediaries and advisor intermediaries, transaction intermediaries, and the 2 sides are commonly referred to as the supply side and the demand side in capital markets. Financial intermediaries are institutions or vehicles used to channel capital between a lender-investor and a borrower-investee. They include commercial banks, investment banks, private equity funds, venture capital funds, microfinance institutions, insurance companies, and others. Advisor intermediaries or transaction advisors help to reduce transaction costs and information barriers via a network of in-house and external specialists. They bridge the gap between investor and investee, helping to secure and close deals between them. Their services include preparing financial, marketing, and legal documents, conducting due diligence, and more. In blended finance transactions, transaction advisors often act as the blenders of capital, so they need to be able to work with the deal's many different actors to accommodate their individual needs. So just a point here that, in blended finance, when we're talking about this kind of interesting idea really of taking capital with totally different objectives, right? Grant capital not seeking a profit, and impact investment seeking a profit, and mixing these, right? So that's kind of what blended finance refers to, and that mixing process is not necessarily that simplistic. So we're seeing these other parties that are needed to actually structure these arrangements for the benefits of those that are trying to get the investment. They must structure investments that combine varying risk-return profiles while using methods that are replicable and scalable. In private sector transactions, transaction advisors are compensated after the closure of a deal, at which time they receive a percentage of its value as payment. However, the increased risks and smaller deal size of developing markets deter transaction advisors who are compensated only through these means. In a blended finance transaction, development agencies can use their resources to cover all or part of the transaction advisory costs via a payment scheme that combines both the base and a performance fee. Why are international development agencies pursuing blended finance strategies? International development agencies such as USAID aim to reduce poverty and inequity while improving health, education, and employment worldwide without damaging the environment. Because they draw in private capital, blended finance tools ultimately allow international development-focused agencies to make progress towards their objectives, far beyond what they could achieve with their own limited budgets. So this is again not actually the word catalytic. The word that's coming to mind for me as I'm reading this is synergistic. That basically you have two sets of people looking to invest in emerging markets. You have the limited resources of the international development agencies. You have private capital, which is also to an extent limited. But if these two entities can be brought together, we can create blended finance structures, vehicles, and transactions, which can have a multiplier effect on the target markets, right? Because it might make the capital less choppy. There's greater continuation if it's coming from multiple sources on the supply side, and it might simply scale it up because you're not looking at capital supply from one of those two pools of actors, the grant capital from the development agencies or the private capital from the investors. You're having those pooled together, and that's simply putting more money in the pot for these developing markets. So synergistic is the word that's springing to mind for me. I thought I'd just throw in that comment. Engaging the private sector and deepening local finance markets are also integral aspects of helping developing nations to progress on their journey to self-reliance, defined as a country's capacity to plan, finance, and implement solutions to their development challenges. USAID recently reoriented its policy framework around assisting partner nations on this journey. In other words, it aims to use foreign assistance funding to help developing nations to see their development solutions through effectively. By ensuring that these solutions are implemented inclusively and with accountability, USAID's work is playing an important role in closing the global development gap, thereby working towards a time where foreign aid is no longer necessary. At the moment, however, the global development gap is still vast, estimated at trillions per year. Development agencies and philanthropic organizations do not have the resources to fill this funding gap on their own. After all, official development assistance from government aid worldwide is only about $150 billion per year. So let me just read that sentence again. After all, official development assistance from government aid worldwide is only about $150 billion a year. See, the thing that I find tricky when reading in impact investing is all these numbers sound quite big. 150 billion sounds like a big figure, but when you realize that figure is the total of all ODA from all the governments in the world, you begin to realize that that's not actually that much money. Closing this gap thus requires mobilizing the world's largest financing pool to private capital. Unfortunately, many developing countries have unattractive investment climates that negatively affect the appetite of banks, institutions, and individuals to lend to and invest in businesses and projects operating in their jurisdiction. Numerous barriers prevent capital flows into these markets, including weak liquidity, high market volatility, exchange rate fluctuations, small size of individual investment opportunities, and potential investors' lack of familiarity. Good blended finance transactions not only mitigate investment risks and align private capital with immediate development needs, but they also have a positive long-term impact on local financial ecosystems, an important stepping stone on a country's path to self-reliance. Blended finance projects are projected to generate revenue and or to appreciate in value, thereby enabling them to be sold to repay the investment. As a result of this pathway to commercial viability, development agency support is anticipated for a finite period of time, making blended finance investments more suitable than those activities funded solely by public or philanthropic resources. How does blended finance differ from other sustainable investing trends? Blended finance can be understood within the broader landscape of sustainable investing and benefit from its momentum. Sustainable investing began with a negative screening toolkit in which investors avoided investments that conflicted with their values and worldview. For example, avoiding investments in alcohol, tobacco, or firearms. The trend then progressed to environmental, social, and governance (ESG) integration, in which investors considered the sustainability and ethical impact of an opportunity as part of their investment assessment. A third trend, impact investing, in which investors actively look for investment opportunities that create measurable positive social or environmental impact alongside financial returns, has grown rapidly over the last decade. Blended finance is a structuring approach designed to allow different types of capital, whether impact-oriented or commercial, to invest alongside each other while achieving their own set of objectives. Government and philanthropic organizations can reach their social and environmental objectives, and private sector investors can make the financial returns which they require. Although impact investors often participate in blended finance transactions, the structure makes it possible for investors to partake in a deal without having the intention of creating positive social or environmental results with their investments. The focus on achieving market rate returns means that investors with fiduciary responsibility, such as those managing pension funds or insurance companies, can consider participating in these transactions. By making investment opportunities in emerging and frontier markets accessible and appealing, blended finance has the potential to attract private capital at the scale needed to solve the world's development challenges. And we have a diagram here of blended finance compared to other forms of funding. Typical forms of funding, development agencies and philanthropic organizations, they prioritize social and environmental returns above financial returns and recouping capital. Their impact targets are intentional. Their investment risk appetite is risk tolerant to neutral. And the key actors involved in this type of financing are development agencies, donors, NGOs, and individuals. Then we have impact investors. They prioritize a combination of social environmental returns and financial returns. The trade-off between these results and returns depends on the individual investor. Their impact targets are intentional. Their investment risk appetite tends to be neutral to risk averse. And their key actors are impact investment. The key actors doing this type of investment are impact investment firms, or I would add also private impact investors. Finally, we have the commercial investors. They are seeking the highest level of return. They prioritize returns that are at or above the market rate. Their impact targets are unintentional typically. Their investment risk appetite tends to be risk averse. And the key actors we're talking here are banks and institutional investors. So in a blended finance transaction, we have the commercial investors, the impact investors, and the development agencies. Three different groups of people with different investment risk appetites, different returns are seeking, but we're putting them all into the blended finance structure. And the blended finance structure then is dispersing out to companies, projects, facilities, platforms, and funds. So that is the magic of called blended finance, that we're taking the three different groups, pooling it together, and then putting it outwards. 7. When should organizations use blended finance? Blended finance can be used to address development challenges for which financing is a constraint and for investable activities that will produce enough cash flow over time to provide an investor with acceptable returns. As such, it cannot be used to address all the world's development challenges. So that's important to state, that none of these people who are presenting these tools realistically, I think, nobody can really present one particular type of financing as a panacea for all the financing shortfalls needed to meet the SDGs, or more simply, all the problems in the world, right? And we saw this in the previous episode talking about, from the Government Outcomes Labs, talking about impact bonds, SIBs and DIBs, giving criteria for when they make sense, and they were very clear and transparent that they don't always make sense. There are certain forms of social good, like if you want to bucket disaster recovery, stuff like, if there's been weather disasters, that setting up something like a social impact bond is just not suitable for that type of social delivery. So likewise for blended finance, they don't always make sense. Nonetheless, approximately half of the funding needed to close the global development gap could come from private investment. Blended finance can be deployed across the lifecycle of a project, from its preparatory stages through to ensuring its long-term commercial viability. The blended finance approach, such as the amount of catalytic capital or technical assistance provided, can be tailored for every stage. For instance, in early stages, the financing might mostly come from donor-provided catalytic capital, and the technical assistance might revolve around foundational groundwork such as conducting feasibility studies. However, at later stages, the financing might be comprised largely of commercial investment, with international development agencies providing a concessional guarantee. So if we think about the blended finance structure as perhaps a mixing entity, right? The percentage of each form of capital, the development, the grant capital, the impact investors, and the commercial investors, can actually fluctuate throughout the lifetime of the blended finance structure or vehicle, with the point they're trying to make here. Example of blended finance is deployment over a project's life cycle. And they have in this diagram here, it's to describe it visually, moving from concessional capital through to commercial capital. So I'm going to actually read it through the stages and the illustrative blended finance deployment for anchor business and agricultural value chain. So I'm going to actually just read the top half of this. In the first stage, the preparation stage, we have grants or technical assistance to conduct project preparation. In the formatory stage, we have, called formation here, we have early stage equity investments with significant first loss capital to pay for legal and other startup costs. Construction phase, we have potentially blended commercial debt equity investment from a facility with a concessional first loss guarantee. Management phase, commercial debt and equity with a concessional guarantee to reduce the financing cost for the operator. And the exit stage, exit to a purely commercial buyer of the asset. Point 8. What conditions make for successful blended finance transactions? All blended finance transactions should have 3 signature markings that demonstrate the alignments of private and development interests: additionality, impacts, and returns. Additionality offers proof that the blended finance intervention, catalytic capital, insurance, technical assistance, etc., generated meaningful private sector participation that wouldn't, and these are the critical words, that wouldn't have happened otherwise. Impact illustrates the ways in which the investee or investable project contributes to sustainable development in a developing country. And finally, returns demonstrate that the transaction is expected to generate a profit, the size of which varies depending on the private sector investors involved and whether they are primarily seeking profits or impact. Blended finance is best suited to situations in which an investment clearly has a projected social or environmental impact, as well as projected financial returns or investment, or to situations where it can address market failures, affordability, constraints, or information deficiencies that have hindered private sector development. In such situations, risk mitigation measures such as a development agency taking the first losses to protect private sector partners can motivate commercial investors to come to the table. While blended finance is designed to overcome market challenges, it can't compensate entirely for the failures of a poor enabling government. Projects in these environments may require long-term subsidies or major political changes in order to be successful. For example, if a country suffers from extreme corruption, political instability, weak legal systems, and unpredictable government, then private capital will not flow into the market at scale. Governments must address these issues, but blended finance projects can play a supporting role. While no amount of blended finance interventions can fully compensate for a weak enabling government, blended finance projects can have demonstration effects that lead to policy changes, and they can strengthen local intermediaries, helping capital markets to function better. Blended finance approaches can therefore reinforce efforts to improve enabling environments, making such efforts more effective. Point 9. What is additionality? Simply put, additionality refers to the evidence that an international development agency's intervention generated meaningful private sector participation that would not have otherwise happened. International development agencies participate in blended finance deals to bring private capital into a transaction. Catalytic capital, guarantees, and technical assistance often result in the closing of a deal. If private capital would have entered the deal at the same value and it was the same conditions or time frame without the development agency's involvement, then we can say that there is little to no additionality. Additionality provides the rationale for pursuing blended finance strategies. Without proof that blended finance helps secure additional financing or improves a project's development, international development agencies run the risk of simply wasting resources on transactions and projects that would have been equally successful had they not been involved. The worst case scenario is that their resources actually crowd out private capital that would have come naturally into the transaction had the development agency not stepped in to fill an unassumed void. What are the challenges of evaluating additionality? Unfortunately, additionality is difficult to prove because blended finance transactions do not function like science experiments that carefully compare an intervention versus a control group. No alternative transaction exists to quantify the amount of money that would have been raised without the intervention. Likewise, a project can't quantify how successful or unsuccessful it would have been had additional private capital not been mobilized. Often, international development agencies report leverage ratios, the amount of commercial financing which was mobilized by development capital. So that's a useful term to know. Leverage ratio, again, the amount of commercial financing mobilized by development capital in their blended finance transactions. However, the blended finance ecosystem lacks a universal methodology for calculating these leverage ratios, which makes comparing ratios from multiple sources difficult. The risk profiles of blended finance transactions differ depending on the particularities of the investment transaction. The sectors and markets in which specific transactions occur also influence the relationship between development funding spent and private capital mobilized. Likewise, leverage ratios also change depending on the type of blended finance intervention used. For instance, the leverage ratios of a guarantee or technical assistance may be very different than those of a catalytic capital investment, even if used in the same sector or market. All of these factors make comparing leverage ratios across different blended finance transactions to be very challenging. The relationship between leverage ratios and additionality is also complicated. At face value, high leverage ratios seem positive because they show that a significant amount of private capital spent per donor dollar. However, high leverage ratios can underscore that the blended finance intervention was not truly needed. For instance, if a deal attracts a significant number of high-value private sector investments, then it's possible that would have attracted commercial investments without development agency participation. Blended finance transactions with lower mobilization can be shown to have high additionality because they reveal that a development agency influenced commercial investment in an area with significant risks but high social or environmental returns, such as investing in conflict-affected areas or the least developed countries. Thus, high leverage ratios may actually be at odds with additionality, signifying an unnecessary blended finance intervention rather than a successful one. So this question of additionality and these mobilization ratios is complicated, right? It's not simply that the higher the mobilization ratio, great. Because we had catalytic capital, we brought in more commercial capital. It could actually mean the opposite, that there was actually no need for the development agency to put together this complicated blended finance structure that accrued transaction costs, because the commercial investors were going to come in anyway. So that's all I'm going to say about this, is that it's complicated. And that actually brings us to the end of this report from USAID. I think that was a really, really good introduction actually to blended finance. It's again called the USAID Invest Blended Finance Starter Kit, March 2020. Unfortunately, no authors were listed, so there's no one I can credit for writing this report or group of people, but I want to say thanks to USAID for making this available. I hope my audio reproduction has been useful. And of course, if you want to receive more episodes of this podcast, please subscribe at readingsiниmpact.org, and you can find there a link to your favorite podcatcher in order to get this podcast there. And finally, it's also being mirrored onto YouTube. So if you want to search on YouTube for Readings in Impact Investing, you should also be able to find it. Thank you very much for listening to today's episode. And until the next time, have a good day.